Namaste. We learned about the meaning of cash flow statement, the objectives, advantages and limitations of cash flow statement in the previous session. Then we learned about the format of cash flow statement, how to compute profit before extraordinary items, then how to go about preparation of cash flow statement. Now we are all set for going in for the numericals. But before going in for numericals, it is very safe to know the general instructions. Once we are thorough with the general instructions, we will not make any mistake at all. These are all the guidelines or ground rules to be followed. And once you are thorough with these general instructions, just like that you need to apply them in the practical problems. There ends the matter. It's very, very comfortable. Now, number 1. How are we going to compute profit for the year? Now we know pretty well that step 1 in cash flow statement is calculation of net profit before extraordinary items. For that, the formula we discussed was with the net profit after extraordinary items, we added extraordinary expenses and we subtracted extraordinary incomes. Isn't it? This is what we did. Now, how are we going to arrive at net profit after extraordinary items? Number 1, if there is only income statement that is given to you and rest all information given as a statement, mere information is furnished to you, take the balance of statement of profit and loss. That is the balance after all adjustments. From that, you will go back by adding all the extraordinary expenses and subtracting all extraordinary incomes. If only 1 year's profit is given to you, that is a mere statement of profit and loss is given to you. Number 2, in case statement of profit and loss is not given, but you are given 2 years balance sheets, then in that case, difference between current year profits and base year profit. Current year's profits and base year's profits will be the profit for the current year. Now, in that, the next caution to be followed, to be taken care of, will be you are given a financial statement. You are given the notes to accounts. In that, you have reserves and surplus. In that, you are given statement of profit and loss. This is 2021. This is 2020. So, current year's profit, assume it is 10 lakh and base year's profit is say 8 lakh. In that case, profit for the year happens to be 2 lakh rupees. Suppose current year's profit is 8 lakhs and base year's profit is 10 lakh. There is a loss of 2 lakhs. You start with an unfavorable balance. Next, base year, there was an unfavorable balance of 10 lakhs and the current year, there is a favorable balance of 8 lakhs. What does it indicate? After covering the base year's loss of 10 lakh rupees, current year there is a profit of 8 lakhs, which means current year there is a profit of 18 lakhs. Current year there is a profit of 18 lakhs. Other way around. Base year, there is a profit of 10 lakh and current year, there is a loss of 8 lakhs. That means, even after adjusting the profit of the base year, the loss is 8 lakh. That means, loss for the current year is 18 lakhs. Current year minus base year will be the profit for the current year. Therefore, we will arrive at the profit this way only. So, I repeat, if only one statement of profit and loss is given, the balancing figure of statement of profit and loss will be taken as a base for calculation of profit before extraordinary items. In case if 2 years figures are given, then the difference between current year and base year will be the profit for the current year. In case if the base year is showing a favorable balance and current year is also showing a favorable balance, difference between current year and base year will be a profit for the current year or loss for the current year straight away. Suppose current year is favorable balance and base year is an unfavorable balance, minus into minus becomes plus, minus of minus becomes plus. So that means after covering the loss of the base year, the profit is so and so. And it is the other way around, when current year is an unfavorable balance and last year is a favorable balance, minus minus, so it becomes total minus. So it is totally unfavorable balance. So this is care to be taken, first instruction to be taken into consideration. Now, going to the second one, accounting treatment of proposed dividend. Accounting treatment of proposed dividend. Now, proposed dividend of the current year will not have any effect in your cash flow statement. What is proposed dividend? That is a dividend which is proposed in the annual general meeting of the current year, which means it is subject to availability of profit at the end of the year. And once profits are there, it will be paid before the next annual general meeting to the shareholders, which means it will be accounted for only in the subsequent year's books of accounts. Therefore, what is being proposed is treated as a footnote, will be given only as a footnote and it will be shown only in the notes to accounts. It will have no effect in your cash flow statement. So, proposed dividend of current year is shown only as a footnote. It will have no effect in cash flow statement. Current of the base year, there will be two effects. One, added as extraordinary items, extraordinary expense. Two, shown as an outflow from financing activity. This is the very specific instruction about proposed dividend. So, proposed dividend, in case only one figure is given to you, that means that is the dividend to be paid during the current year. That will have two effects. The same amount will be added as an extraordinary expense and shown as an outflow from financing activities. In case two balance sheets are given, if that proposed dividend is given, please remember that proposed dividend will be treated only as a contingent liability. Fine? It will be shown only as notes to accounts. It will have no effect in cash flow statement. So, the base year's proposed dividend, which would have been paid during the current year, leading to cash outflow, will have an effect in your cash flow statement. Effect number 1, added as an extraordinary expense, and effect number 2, shown as an outflow from financing activities. Now, treatment number 3, treatment of interim dividend. What do you mean by interim dividend? The dividend paid in between two accounting periods. This is a dividend paid in between two accounting periods, which is called as interim dividend. An interim dividend is not paid regularly by the company. That is why it is also called as an extraordinary expense. Why? Because the payment of interim dividend depends upon the surplus funds a company has and the company doesn't find any other expense for that. The company doesn't foresee any other expense for that surplus amount. Therefore, the company decides to declare interim dividend. And interim dividend is paid in cash. Therefore, there is a cash outflow. So, interim dividend will always be only one amount. There will be no two amount at all. There will be only one amount. So, that amount, the same amount will be added as an extraordinary item and shown as an outflow from financing activities. So, interim dividend, same amount will be treated as an extraordinary item and shown as an outflow from financing activities. Now, coming to the next one, treatment of short-term borrowings like bank overdraft and cash credit. Bank overdraft and cash credit are not treated as current liabilities as far as preparation of working capital changes is concerned. They are treated as financing activities. So, short-term borrowings like bank overdraft and cash credit will be dealt with only in cash flow from financing activities. Increase in bank overdraft or cash credit will be taken as inflow from financing activities and decrease will be treated as outflow from financing activities. The next is premium on redemption of debentures or preference shares are the additional funds which the company will have to pay to the debenture holders or to the preference shareholders when the debentures or preference shares are to be repaid. So, the company has committed to pay additional amount, extra amount over and above the face value at the time of redemption. Therefore, the company will make payment of premium on redemption along with the principal amount. Therefore, it cannot happen in isolation. Premium on redemption of debentures is not a separate payment. It is to be paid when debentures are redeemed or preference shares are redeemed. Therefore, please remember very carefully, it will be added to the outflow concerned. It will be added to the outflow concerned. So, in cash flow statement, cash flow from financing activities, find redemption of debentures, redemption of dash percent debentures in the inner column, amount and premium on redemption of debentures. The total amount will be shown in the outer column. So please remember, premium on redemption of debentures will not happen in isolation. It will be a part of the outflow concern. It will be added to the outflow concern. Now, coming to the next one, when new shares or debentures are issued at a premium, please remember, increase in securities premium also cannot happen in isolation. It cannot be a separate inflow. It is an added inflow to the main inflow concerned. Therefore, it will be added to the source concerned. It will be added to the source concerned. So, when you are preparing the cash flow statement, proceeds from issue of equity shares, say 10 lakh rupees, and increase in securities premium. Say 1 lakh rupees. This total will come in the cash flow from inflow from financing activities. Now, going to the next one is discount on issue of debentures. Please remember, shares cannot be issued at a discount, but debentures can be issued at a discount. So when we say when shares are issued at a premium, that amount of premium is added to the source concerned. Similarly, when debentures are issued at a discount, please remember the company is not going to pay anything. There is not going to be an outflow, but there is going to be a reduction in your inflow. Therefore, it will be subtracted from the source concerned. So, proceeds from issue of debentures less discount on issue of debentures. So, it is just going to be a reduction in your inflow and there is no outflow at all. Fine. Now coming to accounting treatment of provision for tax. Provision for tax. This is a tax on the income that the company is earning. There is every possibility that there is an income tax refund also. How are we going to treat this provision for tax? Company anticipates some amount of tax to be paid. Accordingly, the company will set aside a portion of its profits towards provision. So, what is called as provision for tax? Now, how are we going to treat it in cash flow statement? Number one, if only one figure is given, only one amount of provision for tax is given, the same amount, so instruction number one, only one amount of tax is given. In that case, A added as extraordinary expense, B shown as an outflow from operating activities. Here it will be the net effect, that is total tax paid minus income tax refund if there is anything. So if only one figure is given, one amount of tax is given to you, the same will have two effects. One added as an extraordinary expense, two shown as an outflow from your operating activities, wherein you will subtract the income tax refund if it is given in the question. Now coming to next one, when two balance sheets are given, with provision for tax. So, adjustment number one, current year's provision will be treated as an extraordinary expense, and base year's provision will be outflow from operating activities. Again, it is net effect. So, if 2 years figures are given, current year's provision will be an extraordinary expense and base year's provision will be outflow from operating activities after subtracting income tax refund. Suppose the third case, when 2 years information is given and additional information is also given. Mandatorily open provision for tax account. open provision for tax account. How are we going to open provision for tax account? Provision for tax account. You will start with Y balance brought down because it's a provision, it is a liability, therefore you have credit balance, Y balance brought down, Y statement of profit and loss, tax provided, which can be a balancing figure, or to bank, tax paid, which can also be a balancing figure, to balance carried down, which is the closing balance. So, either statement of profit and loss, tax provided during the year can be a balancing figure, or tax paid can be a balancing figure. If it is tax provided, this will be an extraordinary expense. And if it is tax paid, this will be outflow from operating activities. So, I repeat the format of provision for tax account. We start with a credit opening balance, Y balance brought down, to balance carried down, by statement of profit and loss, which is an extraordinary expense, that is nothing but tax provided during the year, which is an extraordinary expense, and to bank, which is tax paid. So, you may get either of it as missing figure. And if it is going to be by statement of profit and loss, tax provided during the year, then this will be treated as an extraordinary expense in the cash flow statement. And if it is going to be tax paid as the balancing figure, it will be treated as an outflow from operating activities. Fine? This is the accounting treatment of provision for tax. So the next instruction is about increase in tangible or intangible fixed assets. So, increase in tangible or intangible fixed asset is always purchase and it is outflow from investing activities. And decrease. Please remember, decrease is always depreciation or amortization. In case if it is a tangible asset, it becomes depreciation, and in case if it is an intangible asset, it is amortization, which will be added as non-cash expense while computing cash flow statement, which will be added as non-cash expense while computing cash flow from operating activities. So I repeat, accounting treatment of increase or decrease in the value of fixed asset. Increase in the value of fixed asset, whether it is tangible or intangible, it is always considered to be purchase and it is an outflow from investing activities. Decrease does not mean sale, irrespective of whether it is land or any other asset. Decrease is always treated as depreciation or amortization depending upon the type of asset, and it will be added as non-cash expense for computation of operating profit before working capital changes. Now, going to the next one, interest on long-term borrowings. To be paid irrespective of any instruction, any information. To be paid. So, one effect added as non-operating expense and 2 outflow from financing activities. Outflow from financing activities. So, accounting treatment of interest on long-term borrowing. Interest on long-term borrowing will be paid irrespective of any information because it is a commitment by the company towards the lenders. Therefore, even if no information is given, it will be paid. It will be computed and it will be paid depending upon the duration for which the funds are raised. So, one effect is it is a non-operating expense, therefore it is added to operating profit before working capital changes, and the second effect is it is shown as an outflow from financing activities. In case in a question, if you are given information about equity dividend, suppose the information is very clear that the company has only equity shares, no problem at all, equity dividend will be paid. But in the given balance sheet, if there are preference shares, with a prefixed rate of dividend and the information is silent about preference dividend, it is implied that only after paying preference dividend will the company pay dividend on equity shares. So that should be very carefully noted down. These are all the hidden information which we will just like that overlook because we are not very clear about that. Please be very clear. In a particular question, when you have equity dividend to be paid, check immediately if in the given balance sheet there is preference share. If there is preference share capital, check if there is a prefixed rate of dividend. In that case, the company will have to pay preference dividend, then only pay equity dividend. It is an implied information. Therefore, after meeting out the dividend on the preference shares only, the company will go for equity dividend. So, this is another instruction to be taken care. In the next session, we shall be discussing about the ledger formats to be prepared for fixed asset account, investments account, debentures account, securities premium account, equity share capital account, so that we will know how to treat the respective items in the cash flow statement. Namaste.